Tax season can sometimes feel like you're trying to solve a giant, complicated puzzle. But what if I told you there's a piece of that puzzle that's actually designed to save you money? Today, we're going to demystify one of the most powerful tools on your entire tax return. I mean, seriously, just think about it for a second. Wouldn't it be great? You get to the end, you see the final bill, and then you just get to slap a coupon on the counter that instantly lowers the price. Well, guess what? You totally do. They're not little paper cutouts, of course, but they work in almost the exact same way. They're called non-refundable tax credits, and they are your secret weapon for lowering what you owe. Okay, so what are these things really? Well, when we talk about tax credits, you can basically think of them as falling into two main categories, or two types of tax coupons. And here's the absolute key difference you need to know. A non-refundable credit is super powerful. It can bring your tax bill all the way down to zero. But it hits a wall at zero. Any extra credit value, it just disappears. You don't get it back as cash. Refundable credits, though, they can smash right through that $0 wall and put money directly back into your pocket. So for this explainer, we're going to zoom in on the non-refundable ones. Why? Well, because they are a huge, huge part of your return. In fact, if you look at the federal tax form, this is all handled in Step 5. It's a core part of how your taxes are calculated. All right, let's talk math. And don't worry, I promise it's way simpler than it sounds. How do these credits on a form actually turn into real money staying in your bank account? It's not magic, so let's break it down. To make this really concrete, let's use an example. So this is Isaiah. He's done his homework, he's gathered his papers, and he's figured out that he's eligible for a bunch of different credits. And when he adds them all up, he has a grand total of $20,000. Whoa. Now, hold on, that does not mean he gets a $20,000 discount. Think of this number as just the starting point. It's the base value of all his credits put together. Okay, so what's next? You take that big number, that 20 grand, and you multiply it by a special percentage. It's a rate set by the federal government, and this is what turns that big, claimable amount into your actual, real dollar tax savings. And that rate is 15%. This number isn't random. It's the lowest federal income tax rate. And it's the rate used for all these federal non-refundable credits. So we take Isaiah's $20,000 and we multiply it by 15%. And this right here is the most crucial part of the whole process. This is the moment that $20,000 number gets converted into a real tax saving. And for Isaiah, that final number comes out to $3,000. See? That is the power of these credits. That $3 grand is directly subtracted from the federal tax he has to pay. It is a straight-up, honest-to-goodness discount on his final tax bill. Okay, so now we know how a $20,000 credit becomes a $3,000 discount. But the real question is, how do you find those credits in the first place? Well, think of it like you have a personal toolbox of credits available. Let's open it up and see some of the most common ones you might be able to use. All right, first up, we've got the foundational stuff, personal and family credits. The basic personal amount is the big one. Why? Because every single taxpayer gets to claim it. It's basically the government saying, hey, you need a certain amount of money just to live, so we won't tax you on it. Then there are credits for if you're supporting a spouse or a common law partner who has a low income. And there's a similar one if you're single and you're supporting a dependent. So let's take a look at Naya's situation. She's a single mom and her child is 1 year old. Because she's the one providing all the support for her child, she gets to claim the full amount for an eligible dependent. This credit is designed for someone in her exact situation. And just so we're all on the same page, when the CRI says dependent, all they mean is someone who relies on you for the basics. Food, a place to live, clothes, that sort of thing. Now, if you're an employee, guess what? You're earning credits just by going to work. Your T4 slip is like a treasure map. It shows you exactly what you contributed to the Canada pension plan and what you paid in employment insurance premiums. Since you have to pay into these programs, the government gives you a credit back on those amounts. Plus, most employees get to claim the Canada employment amount, which is just a little something to help with work expenses. Okay, calling all students. Listen up, because this one is an absolute game changer. The money you pay for tuition is one of the biggest non-refundable credits out there, and how you use it can literally impact your finances for years. Now, it has a very specific order. First, you have to report your tuition fees, which you'll find on your T2202 form. The golden rule is you must use them to lower your own tax bill to zero first. If you still have some left over after that, you can transfer up to $5,000 of that leftover credit to a parent, grandparent, or your spouse. And if there's still some left, you get to carry it forward and use it yourself in the future. It's like banking your credits. Let's see how this works for Shakira. She paid $8,000 in tuition, but because she didn't have much income, she didn't owe any tax this year. So she played it smart. She transferred the max, $5,000, to her parent, which lowered their tax bill. And the other $3,000, she banks it, carrying it forward to use on her own taxes in a few years when she's earning more. Brilliant. So, we have covered a lot of ground. What is the one big idea you should walk away with today? It's actually really, really simple. Look, tax software is amazing. It does all the hard math for you. But it's not a mind reader. It only knows what you tell it. The number one reason people miss out on credits is because they just didn't know they could claim them. Understanding why these credits exist is what empowers you to make sure you're not leaving your own money on the table. So I'll leave you with this question. Now that you know how this all works, what's the first credit you're going to double check on your tax return this year? Because knowing where to look, well, that's the whole ballgame.